Good morning, everyone. Now, in this video, I would like to share you the last part of chapter 14 that we supposed to have this in the classroom, but since some of your friends are not able to come because of the field trip, I would like you to review this video as well as at yourself, look at the material and do some reviews. And we will do some of the exercises and problem on Wednesday. So this is just a conclusion video for chapter 14. Now I'm going to share you the screen of this chapter. So this chapter is related to the decision making by managers that managers has to take in their business related to the relevant cost and benefits. Okay, so that is what we discuss in this chapter, and we are already talking about the first one here, that is talking about add or drop a product, where we learn that manager can make the decision whether to add or to drop a product, depends on what are the result of the contribution margin. Now there are things that manager has to think of, which is the elements of some fixed costs that are not avoidable, or avoidable costs that related to such as the sales, contribution margin, and variable costs such as salaries and other fees. All right. So in here, we're going to continue this chapter with this learning objective number 6, to analyze manufacturing decisions involving joint products and limited resources. So what is joint product? Now, joint product is whether sell or purchases further decision that you're going to make can produce or can result in a more value added into the product. So joint production process resulting in 2 or more products. The points in the production process where the joint products are identifiable as separate products is called the split of points. Now the split of points in this example is talking about the cocoa beans. Now cocoa beans that is costing $500 per ton, it is combined together in a joint production process costing of $600 per ton, that you will get the total of a joint cost of $1,100 per ton. You may see that in this slide. Now the split of point happen when the cocoa butter are going to be produced, or cocoa powder. So those are the two products that will happen when we are going to split off the production. Now the cocoa butter, it will result in the sales value of $750 for 1,500 pounds. It's in here. Now the next product is the cocoa powder. Now the cocoa powder can produce of sale value of $500 for 500 pounds. It's in here. Okay. Let me try to look for the highlights. So in here, okay, so this is the cocoa butter, and this is the cocoa powder that you can see. Now, there is a separable processing cost of $800 in here. And with the separation from the cocoa butter and cocoa powder, now instant cocoa mix can be produced. Now the sales value of the cocoa mix is higher, which is $2,000 for 500 pounds. Okay, as the result. That's what happened here. So in here, we learned that manager has to make decision whether to split the cost or to process more of cocoa beans. Okay. Let me erase all these notes. Okay. So the joint process in this instance about cocoa, you may see it here. This is the joint cost of 1,100. Okay. And the joint products of cocoa butter and powder is the total, the sales value for each is 750 and 500. If you go back, you see the 750 and the 500. It is shown here, 750 and 500. Now the proportion of it is 60% and 40%. Now 60% comes from 750 divided by 1,250. You will get 60%. Now the 40% comes from 500 divided by 1,250 equals to 40%. Now the proportion should be 100% in total. So when you times 60 with the 1,100 of joint cost, you will get the cost of 660 for cocoa butter and 440 of cocoa powder. The total of joint cost is $1,100. Yeah, you can see it here, right? That's the allocation of joint cost. So when manager is going to make decisions whether to join the cost or to process more, they are able to find the information. Now, cocoa butter is sold at the end of the joint cost processing. Okay, the cocoa butter. Now, cocoa powder may be sold now or processed more into becoming a cocoa mix. So further processing costs that happens is $800. It will incur if a company elect to make instant cocoa mix. So if you want to process more, there's a cost of $800 that will incur. So the decision whether to process more or not, it will show here where if the cocoa mix is being produced, remember the amount, the value of sales will be 2,000. Okay. And if the sales value of cocoa powder is $500, it's shown previously. You will see here. See, powder is $500. So $2,000 minus the sales value of cocoa powder of 500 equals the increment revenue of 1,500. So you deduct 2,000 with 500, you will get 1,500. Now you less the production or separable processing cost of 800 for the cocoa mix of $800. So minus $800 from $1,500, you will have the net benefit of further processing of $700. It's shown here. So as a manager, the cocoa powder should be processed into instant cocoa mix because it will still show the benefit, net benefit of processing further of $700 if you want to process the cocoa into a cocoa mix. So that is the joint products if you want to process more further. So the decision involved in whether to process more or not, it depends on the manager. Now, in this instance, there's another terms that involves some of the limited resources. So for company that do not have a lot of resource, they need to think whether they have a limited resource or no resource at all. So firms often face the problem of deciding how limited resources are going to be used if you have only limited resource. Now, usually fixed costs are not affected by this decision. So management can focus on maximizing total contribution margin. Now, for the example here is talking about the Martin Incorporation. So Martin Incorporation has two products that they're going to sell. The data is shown here, webs and highs. So for webs, the selling price per unit is $60. For highs is $50. Now there's a variable expense per unit of 36 for webs and highs is 35. You will get the contribution margin per unit for webs is $24. For highs is $15 because 50 minus 35 equals 15. 60 minus 36 equals 24. So this is the contribution margin per unit of these two products. Now there's a current demand per week in units for webs of 2,000 units and for highs is 2,200 units. Now the contribution margin ratio is 40% for webs and 30% for highs. And the process time required on the latte per unit is 1 minute per unit, and for highs is 0.50 minutes per unit for producing highs. So the latte is the scarce resource because there is excess capacity on other machines. The latte is being used at 100% of its capacity. Now the latte capacity in these cases is 2,400 minutes per week. The questions that's being asked, should Martin focus its efforts on webs or on highs? Okay, based on this information, we will see. So the contribution margin per unit is 24 for webs and highs is 15. It is in dollars. And the time required to produce one unit is 1 minute per unit for webs and 0.50 minute for highs. So the contribution margin per minute will be 24 divided by 1 equals $24. And that's for webs, and for highs is 15 divided by 0.50 equals $30 per minute for highs. So highs should be emphasized. Why? Because it is more valuable use of the scarce resource, the latte, yielding a contribution margin of $30 per minute, as opposed to $24 per minute for webs. You are able to see it here. So manager has to emphasize more in producing highs because it gives more contribution margin per minute to compare than webs that's only have 24. Okay, so in this example, let's see how this plan would work. You see the scarce resource for latte. The weekly demand for highs is 2,200 units. It's given in the previous slide, right? Weekly demand of 2,200, you see here. Okay, let's find it. Okay, here. 2,200 for highs and 2,000 for webs. Okay, so let's see. The weekly demand for highs is 2,200 units times the required per unit in minutes, which is 0.50 minutes. You will get the time required to make highs equals to 1,100 minutes. All right. Now the total latte time available is 2,400 minutes. It's given here 2,400 minutes. Okay, that's the capacity, 2,400. Now the time required to make highs is 1,100 minutes. So when you minus 2,400, the latte time available with 1,100 minutes for time required to make highs, you will get 1,300 minutes for time available for webs. Okay, so 1,300 times 1, you will get 1,300 units for producing webs. All right. So according to the plan, Martin will produce 2,200 highs and 1,300 webs. Now this is the Martin contribution margin will look like this. So 1,300 of webs production in units times 24 of contribution margin per unit, you will get the total contribution margin in dollar amount is 31,200, right? 1,300 times 24. And for highs, 2,200 times 15, the contribution margin per unit, you will get 33,000. So the total contribution margin for Martin Incorporation will be 64,200, which is 31,200 plus 33,000 equals to 64,200. Now, any other combination would result in less contribution. So this is how to find whether you're going to use the limited resources or not. All right. So in here, the theory that constrains or limit the computation is the binding constraints can limit a company's profitability. Now, to relax constraints or limitation, management can do all of these things below. Outsource all or parts of the bottleneck operation. That is one strategy. The second one is to invest in additional production equipment and employ parallel processing. So a manager can also add, buy, invest more production equipment, or to do some parallel processing. Okay, that's the second strategy. Or management can assign work overtime at the bottleneck operation, because the term bottleneck, right? When the operation are being stuck because too many inflow that's coming, that the result of the inflow will be less because bottleneck, the concept of bottleneck. So one of the solution is to have an overtime operation. Or the fourth one for strategy is to retrain employees and shift them to the bottleneck. So you train your employees that work in different departments to work in the bottleneck department. So it will ease the bottleneck. And the fifth strategy is to eliminate any non-value added activities at the bottleneck operation. So maybe the cause is some other activity that happens that will result in the bottleneck. Maybe it is non-value added activities that you can eliminate. So these are some of the strategy that management can do to relax the bottlenecks or constraints, limitation. Now, talking about uncertainty, one common technique for addressing the impact of uncertainty in the production is sensitivity analysis, a way to determine what would happen in a decision analysis if a key prediction or assumption proved to be wrong. So you need to look at the sensitivity, same as in research. You need to find something or areas that is so sensitive that can can cause a problem to happen. So you are doing some sensitivity analysis. It is the way to determine what would happen in a decision analysis if a key prediction or assumption that is provided would go wrong. Okay. Now, for example, in here, expected values. From the last example, recall the contribution margin for webs was 25 and 15 for highs. Due to uncertainty, assume that Martin has the following probable contribution margin for the two products, example, webs and highs. You see, possible value of contribution margin, this is talking about probability, is the contribution margin is 24. So we can assume maybe if it's less, it becomes 23. If it's more, it becomes 25, right? So add $1 to each, add or minus $1 to each. Now the probability could be 30% when it is less, or 20% when it is more. And when it is the same, is 50%. So from the web, the expected value, if the probability is 30% out of $23 of contribution margin, you will get $6.9 as an expected value. Now, if it is 24 contribution margin, $24, the probability is 50%, you will get expected value of $12. And if it is $25 of contribution margin, the probability is 20%, you will get expected value of $5. So the total of probability expected value here is $23.9, $23.90. That is the expected value out of this probability. That is for webs. And for highs, the possible of contribution margin is $15, right? So more or less is 14 or 16. Now the probability is 10% and 40% for 15 and 50% for 16. So the expected value you will get 10% of 14 is $1.4, 40% of 15 is $6, and 50% of 16 is $8. The total expected value will be $15.40. So Martin would use the expected value contribution margin in its decision about utilizing its limited resource of latte. Okay, so that is how to use the probability expected value. You use the lower or higher to determine the expected values. So that is learning objective number 6. Now we move on into learning objective number 7. We need to explain the impact of an advanced manufacturing environment and activity-based costing on a relevant cost analysis. Now we already know about ABC costing, right? So the relevant cost analysis and ABC costing, the concept underlying a relevant costing analysis continue to be completely valid in an advanced manufacturing setting. So you can apply the ABC costing into this relevant cost analysis. Now in this chapter, we will not see that in details, but it says that it is valid, that you can apply that. The objective of the decision analysis is to determine the cost and benefits that are relevant to their decision. That is the objective, to determine the cost and benefit that are relevant to their decision. So you can apply this activity-based costing in the relevant costing. Now you can also apply the traditional, the volume-based costing or the ABC costing. But we learned in the previous chapter that ABC costing is much better because it is more precise. It gives a detailed information because the distribution of the cost for ABC costing is much more accurate than the traditional way. So what will be different in setting where activity-based costing is used is the decision maker's ability to determine what costs are relevant to a decision. Now, using ABC costing, it is much more precise, much more accurate because it gives more detailed information. Where to compare with the traditional way, it is only using the overhead cost, right? It's only one base of overhead costing. So it is not so precise. So that is the activity-based costing. Now, other issues in decision making, it involves in incentives for decision makers, where decision makers needs to have incentives, right? Now, incentives also affects the way decision makers run the operations. That is number one. Number two is the short run versus long run decisions. If company are running into problems to make decision, manager has to decide whether it is a short term or long term, long run or short run. So it is very important. Now, the next things that management needs to know is the issue related to the pitfall that they need to avoid. Now, we learned previously about sunk cost, right? Where people sometimes they don't consider sunk cost. It is important to still consider what is the sunk cost. Also, to understand that the unit fixed cost price cannot be unitized, or the fixed cost cannot be allocated according to the unit. It has to be allocated in general or as a total, because unit size fixed cost can distort the information. Also, not to forget about the allocated fixed cost. Allocated fixed cost is also important, and opportunity cost. So do not avoid these four elements: sunk cost, unit size fixed cost, allocated fixed cost, and opportunity cost, because it is important for management to think in making a decision. For example, like opportunity cost, they are costs that a manager or company sacrifice to gain something. That is what the opportunity cost, right? That you need to think of. So this is the end of chapter 14. I hope you have time to review it, and then on Wednesday we will do some of the exercises. So thank you for taking your time to listen to this conclusion of this chapter 14. You have a good day.